BJ's Wholesale Club is an undervalued stock to buy now, and it is a competitor of Costco. We're going to run through the numbers. We're going to look at the historical performance of the company. We're going to look at their income statement, their top line, as well as their bottom line growth year on year. We're going to look at the company's health, look at their balance sheet, total cash versus total debt to see how strong this company is. And we want to compare them to some other competitors of a smaller size, such as Carrefour and a few others. We're also going to dip in to see what the institutions are doing. Are they buying or selling? As well as looking at some very important financial metrics. For those that are not familiar with this company, we are going to run through their investor presentation. And finally, as always, we will take a look at this company through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, for those that don't know, it is very similar in the way it operates to Costco. It is a wholesale club. So you do need a membership to enter to buy wholesale products at a supposable cheaper price to the supermarkets such as the Walmarts and the Targets. Now, before we get into the investor presentation, let's take a very quick look at the company. Now, year to date, it is down around 5%. It is trading towards the mid to lower end of the 52-week range with a forward PE of just under 17. Now, it doesn't currently pay a dividend, and investors who have been holding the company over the last 5 years would be up around 221%, which is very positive to see, especially the way this graph is going. It is going upwards towards the top right, which is very positive with very minimal dips along the way. So let's take a very quick look at the PowerPoint presentation on the investor side to see what exactly the company has performed. Now, taking a look at their Q3 performance, what we can see a few things to note. Their net sales around 4.8 billion, up 2.8% versus Q3 of FY22. They have 7 million or more, in fact, members, and this is up 6% versus the last quarter. And we can see MFI, the membership fee increase, plus 6% versus quarter 3 of last year. So lots of positives to note. And we can see that this sector is really increasing over the last 10 years. We can see on average from 2007 to 2022, the US warehouse club market size has compounded on average around 6% every single year. And we can see over the US sales by the different channels, the retail, the grocery, we can see it makes up around 11.1%. Now, in terms of their membership fees, well, this is what we can see in terms. Now, the company has been around for nearly 40 years, but it was only recently publicly traded in 2018. And we can see their membership fee on average has grown at a compounded rate of 8% every single year. So this is one way that they do generate their revenue alongside the typical sales of their goods in the stores. Now, in terms of how they differentiate themselves from other companies, well, we can see here how they differentiate themselves between Costco and Sam's. They say they have a broader assortment of goods. They have smaller sizes, which is very difficult to find in Costco, convenient locations, and a full service deli. In comparison to the grocery stores, less prices, approximately 25%. They also have services as well as fuel stations. And below the mass channels, we see prices that are even below those with larger pack sizes. Now, jumping into the numbers and on the income statement, you know that top line 3 to 7% growth is what we like to see. Around 13 billion reported in February 2019. Latest annual report of January 2023, 19.3 billion. So some nice increases to see, around 50% over the last 5 years. And on a more granular level, we do see some nice increases year on year, which is positive to see. And we'll also look at the last 5 years in percentage form too. Now, in terms of the bottom line, how does that correlate to the top? 127 million in February 2019, 530 million in January 23. So again, we can see some consistent increases year on year on both the top line as well as the bottom line. Now, how does the health of the company look? Total cash versus total debt. Well, 2019, they had around 27 million worth of cash on their balance sheet. Latest quarter report around 33 billion. So they have increased their cash position over the last 5 years. In terms of their total debt, how does that compare? 1.9 billion in 2019, 3.1 billion in their latest report. So they are holding a significant amount more debt than they did 5 years ago and at a faster rate of an increase in comparison to their cash. Now, on a total return basis against some competitors, Care4, as well as a few others. Year to date, we can see they are down around 5.2%. In fact, they are in the middle of their peers when we do compare. And expanding the data to 5 years, remember, if you do have 5 years or more worth of data, do take a look and analyze of any company. They are up around 221%, the best performing of their peers. Now, it is positive to see that, but do remember past performance is never an indicator for the future, but we always like to add this to our research on the channel. Now, in terms of institutional ownership, it is sitting very high at around 98.6%. And we see that around 1.68 billion worth of shares have been sold over the last 12 months, with around 2.84 billion bought. So institutions are buying a significant amount more than they are selling. And we can see over the last 4 quarters, they have bought more every quarter than they have sold. But as always, we're not copying what the institutions are doing, and we need to always do our own due diligence and analysis. So let's take a look at our financial metrics. So we can see 8.61 billion market cap. It is a mid-cap company. And then when we take a look at their free cash flow per share, remember, earnings is susceptible to manipulation by management through accounting. So we tend to focus on the free cash flow. 53 cents in 2016, 291 in 2023. So it's nice to see some very strong growth over the last few years. But we do note that it did drop significantly from 2021 to 2023. But it's positive to note in 2024, it is expected to go back up in the right direction to around $4. Now, sales growth, remember, 3 to 7% is what we like to see. Over the back end of the last 10 years, from 2017 to 2020, it remained fairly flat. However, the last 3 years, we do see some nice double-digit growth, as well as 8% strong in 2022. Now, numerically speaking, their revenue has gone from 2016 to 12.5 billion to 19.3 billion in 2023. And we can note that they do some share issuances, which does, remember, dilute your position as a shareholder from around 90 million shares in 2016 to 136 million in 2023. Now, ROIC, remember what we're looking for here, 10% or more, as it does give us faith in management and their ability to effectively allocate their capital. So what we can see here, for the large part, is above that 10%, which is positive to see, especially in the high teens over the last few years. Now, in terms of the margins, this is one area that we would like to see them improve. However, this is fairly comparable to Costco, around 4% over the last 3 years. We would like to see this at around 7 to 12%, and the free cash flow margin at around 5% or more. And over the last few years, it has come down to around 2%. So it is one area that we would tend to monitor over the next few quarters and years. Net debt to EBITDA, though, below 3 is what we like to see. Earnings before interest, tax, depreciation, and amortization. Remember, this signals the number of years it would take the company to pay off all of their debt net of cash on hand. And it has been coming down from 2017 and is expected to come down even lower in 2024. So very positive to see with respect to that. So that is our analysis, and now we can jump straight into the valuation model. Remember, if you do enjoy the content, value is being provided. Hit that like button. In fact, smash the like button. Hit the bell button and the notification, and subscribe to have these videos delivered directly to your doorstep as they drop. And finally, if you want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio and acceptable buy price, then do click on that pinned comment. So we start off with Graham's valuation. So we have the stock ticker, we have the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving an intrinsic value of $55. Now, when we take a look at the current trading price, that is below the current trading price, below the 52-week low as well, showing signs of overvaluation based on Graham's model. Do bear in mind, though, we're not looking at any of these models in isolation. Then we move on to the multiples valuation model, where we have companies in a similar sector and size that we analyzed over the last 5 years. Dollar Tree, Senders, PriceSmart. We have their stock price, EPS, PE multiple, average multiplied by that of BJ's earnings per share, to get a stock price of $77, showing signs of undervaluation in the current market, and right there at that 52-week high. We then move on to what would typically be the third model, the dividend discount model. However, given they currently do not pay a dividend, this model is irrelevant. So we move on to the fourth and final model, the discounted cash flow model, where we see average growth of 75% over the last few years, with analysts estimating around 10 to 14%. So we have gone for the middle. With a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, divide by the shares outstanding to give a DCF price of $84. Now again, that is slightly higher than the 52-week high, showing signs again of undervaluation in the current market. Now finally, the intrinsic value is just the average of these 4 models. Well, 3 as we have removed the dividend discount model. And don't forget to hit that like button if you've enjoyed today's episode, and do subscribe and hit the bell to be continually notified. So margin of safety, we would start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And as we can see right now, it is trading at a 10% margin of safety. Those who would be looking at a higher margin of safety, around 20%, would be looking to buy it around $57. And as we can see, that is slightly lower than the 52-week low. And if we look at the performance year to date, we can see that year to date, the lowest price it has been trading for is around that $61. So it really depends on whether or not you believe this company will dip again. Now, in terms of Wall Street, what do they say? Well, they believe the share price to hit around $80 over the next 12 months. So they do believe there to be some nice upside. So right now you are getting around a 10% margin of safety with some nice upside per Wall Street analyst. As always, let me know your thoughts in the comments below. Is BJ's Warehouse a company you're looking to add to your portfolio? Or if it's a new one that you've just heard about on today's channel, do let me know your thoughts, whether or not this interests you to add in your portfolio. Don't forget to hit that like button if you've enjoyed the episode, subscribe and hit the bell. And finally, if you do want to grab a copy of the valuation model to get to the intrinsic value and your acceptable buy price of companies in your own portfolio, do click on that pinned comment. As always, have a great day and catch you on the next episode.